This video is going to be a little bit longer than the other videos that I'm going to share with you guys because it's very informative. With the video being so long, feel free to pause, come back whenever. It doesn't have to be viewed all in one sitting, but I wanted to go over these loan options with you all. I'm going to be very thorough on this video and I'm going to explain to you in detail what option that you have as a buyer, or if you're a realtor, what options your borrowers have access to. So I'm going to be talking about the main loan options that you may come into play when you are navigating through the home buying process. Some of these you may not have ever heard about before. Some of them you have. If you happen to have any questions regarding any of these loan types or any more details, because there's more components than what I'm going to mention in this video, then feel free to reach out to me and I'll be more than happy to go over those more with you in detail. First loan option that we're going to be talking about, which is the standard one that I'm sure you may have heard about. And if you haven't heard about it, it's okay because it's common that people don't know about these loan options. When I first got into the industry, didn't know anything about these loan options. But the first loan option you have access to is going to be FHA. And FHA is your standard loan. That's pretty much one of the main loan options that you have access to. It is a loan option that is good for people that may not have the best credit. So if you have a credit score of 580 or better, you qualify for 3.5% down as a down payment. If your credit score is lower than 580, so if your credit score is anywhere from 500 to 579, you still qualify for this loan. However, instead of you putting 3.5% down, you are going to have to put 10% down. You do not technically have to be a first time home buyer in order to qualify for this loan. However, you cannot have a FHA loan already if you want to get, you can't have two FHA loans at the same time, basically, is what I'm saying. Their guidelines are a little bit more lax than the other loan options I'm going to be mentioning, but that's the first option is FHA. There are so many different little stipulations, there's different guidelines that come into play. But in this video, we're literally just going to be talking about the loan option. I'm going to be talking about a little bit about the loan option, and then I'm going to be going over the down payment that is required for that option. If you want a more detailed video on each loan option, I'm more than happy to do that. But in this video, we're going to just be literally going over the basics. So the second loan option that you have access to is conventional. So those are FHA and conventional are probably the two most common loans that people do because they're the most common loans that people do. So conventional is going to be a little bit different than FHA. So FHA loans are loans that are regulated by the government. So the government is the one that funds those loans. Conventional loans are not funded by the government. So because they're not funded by the government, they are able to create their own guidelines. And a conventional loan is a loan that is for first-time home buyers. If you purchase a second property, if you're purchasing an investment property, so anything that doesn't fall under the guidelines of FHA is going to be conventional. Conventional is going to be a little bit more stricter than FHA because it is a lot of times can be more riskier than FHA. And when I say that, I'm referring to the fact that it's not backed by the government. So the government, if something happens with FHA loan, the government is able to come in and take care of that. Whereas if it's a conventional loan, that's not the case. The conventional loans are not backed by the government. So basically, if something goes wrong with that loan, then the government's not going to be taking care of that. So with conventional, they're a little bit more stricter on the guidelines. For that loan, minimum, they're going to want a credit score of 620. I know there's times where it may even be higher than that. With conventional, they're more stricter as far as what's on your credit profile. So if you have FHA, if you're doing FHA loan, they may accept late payments, they may accept certain things that's on your credit that's derogatory. However, on a conventional loan, a lot of times they want your credit score, your credit profile to be more clean. And if you have certain derogatory items on your credit, a lot of times conventional, you will not be able to go conventional. So that's the main thing to know about conventional is that they're a little bit more stricter on the guidelines. As far as the credit needed for a conventional loan, you're going to either need they have options for 3%. So I've helped someone get a 3% down. That you will have to have really good credit and you have to have a really clean credit profile in order to get that from my experience. They have 5% down options and then they have 10, 15, 20% down options. Now, one of the things that have recently changed with conventional, I know previously if you're going to be getting a 2 to 4 unit property, the down payment would be 15%. Now, recently, I would say actually in October of this year, the requirement went down to 5%. So if you're going to be buying a 2 to 4 unit property, which people usually do when they're going to be renting, like they're going to stay in one and rent the others out, then you are able to do 5%. That is something that's huge. That's something that has changed versus what it was in the beginning. Depending on the loan option that you do is going to determine what your credit score is going to need to be and what your down payment is going to need to be. If you are a first time home buyer, you can do 3 to 5% down. If you are doing an investment property, you may be looking at 20 to 25% on up, depending on the situation. And also, if you are someone that has a home already and you're wanting to purchase a second property, then you're going to be looking at a 15% down payment. So with conventional, everything that FHA, doesn't cover, conventional covers. Conventional has more stricter guidelines, and they have more down payment options, and they credit is more stricter on what you can have in order to get approved for a conventional loan. A lot of yeah, that's pretty much all I'm going to say about the conventional. Then you have a VA loan. So VA loan is a loan strictly for veterans and for surviving spouses of veterans. So if you are a veteran, if you are a surviving spouse of a veteran, then you will be able to use a VA loan. The good thing about a VA loan is that they do not have a down payment that is required. However, there is something called a funding fee that is required when you have a VA loan. There is a document that the VA will give you that will let you know what your entitlement, meaning what you have to pay for your funding fee. Sometimes it may be 1%, sometimes it may be 2%. It really just depends. I've actually seen someone where they didn't have any funding fee at all. So it's going to be determined by the VA what your funding fee is going to be, but they allow you to do up to 100% financing, meaning there's no down payment. With the VA loan, the good thing about it is that because you're a veteran, they're really wanting to do their best to put you in a home. There's some banks that really will work with you as far as getting you in a home. So that is a option for someone that is gonna be purchasing a home that is a veteran that they don't have the down payment. They do have to come in with their closing costs, which basically is going to be um, so with the VA loan, as far as your closing costs is concerned, there's certain things that the veteran is not allowed to pay for. There's certain things the seller has to pay for in this transaction. So that's probably something I'm going to talk about in a different video, but I wanted to let you guys know about the VA loan and how it works and stuff and how it's pretty much for veterans. If you're not a veteran, then you will not qualify. You have to be a veteran because there is a document that they will give you. It is called, I believe it's called I don't know if it's called. I will make sure I correct myself in this video, but the document is going to be certificate of eligibility. So the document that I'm talking about is going to be called the certificate of eligibility. So if you don't have that, then you will not qualify for a VA loan. This basically is something that will let you know that you qualify and it is something that everybody has. That it has that's a veteran that will qualify, that will have this document, and that's one of the documents that we will need in order to move forward with getting you a VA loan. So we have that. There is a USDA loan, which is a good loan option. USDA loan is called the United States Department of Agriculture. So this loan option is for people that live in that or don't mind living in the outskirts of their city. So, for example, if you live in Bakersfield, then you're going to be looking at Shafter, Taft, Lamont, Lemoore, I believe Tulare. So yeah, those outskirts cities are going to be cities that qualify for or those cities that qualify for USDA. So with USDA, they do 100% financing as well. With the USDA loan option, there is no down payment. You do have to come in with closing costs, but there is no down payment option. So there's a way that you can get in a home without having to pay a down payment. You would just have to pay for the closing costs. The biggest thing about the USDA loan to be aware of is that with the USDA loan, because they are going to be paying the down payment for you, they are going to allow you to have minimal debt. So this loan option is for someone that may not have the money, but you have low debt and you have to have pretty good credit. The minimum credit score required for a USDA loan, I believe it's a 640. So you're going to have a 640 in order to qualify, and you can't have as much debt. One thing that I need to go back to as far as the VA loan, the credit score requirements, they can do a 580, but then also there's a lot of banks that it doesn't matter what your score is, you could qualify. So it really just depends. So with VA, they're very lax as far as the guidelines. Just because you're a veteran, we want to try to get you in a home. We want to do everything we can to get you in a home. So they're going to be a little bit more lax on that. But back to USDA. So USDA is for the outskirts cities. And then, like I said, there's no down payment required. You have to come in with closing costs. But that is a really good option for people that wouldn't mind living on the outskirts of their cities and don't have a lot of debt. So that is an option for you. Another loan option is called the DSCR. And this loan option, I really like this loan option because it is very there is special guidelines. So for DSCR loan, it basically is a loan for people that are already homeowners and they're looking to invest in a property. So when you're a homeowner and you're looking to invest in a property, more than likely you're going to be renting that property out to tenants, or you're going to be renting the property out. So with that loan option, they're not going to use the buyer. If you are the person that's buying the property, they're not going to be using your income to qualify you as we would with any other loan option. With the DSCR loan option, we're basically going to be using the income that you're going to be getting from the property that you're going to be purchasing to determine how much income we can use. So, for example, if you're going to be, let's say you're going to be buying a single family residence a house, and you're wanting to rent that house out to tenants. What they're going to do is they're going to do a what is it called? An inspection to see, okay, well, this property is a 3 bedroom, 2 bathroom. This is how much the market rent you're going to be getting for the property. And then with that being said, they're going to use those figures to determine the income you're going to be getting from that property. And that is what we're going to use to qualify you. The downside to the DSCR, or two downsides to the DSCR loan option, is that number one, your rates are going to be higher. So with the DSCR loan, because it is an investment property, investments are seen as more of a risk to the investors, which is the banks. So they're going to be a little bit more harder on those loan types. And then also they're going to want a little bit more security, which is they're going to be wanting a little bit more interest on those properties. So your interest rate is going to be a little bit higher on the DSCR loans. Also, another drawback is going to be your down payment. So the down payment for the DSCR usually is anywhere from 20 to 25%, depending on a few factors. But usually, I would say to be on the safe side, you're going to be looking at 25% down. But the good thing about those is that that is income producing property. So DSCR is going to be income producing because you are going to be renting that property out to investors or to people that want to rent it out. So I-10 is another option that you have. So I-10 is a loan type for people that do not have a social security number, but they live in California or they live in the United States, but they don't have a social security number. So when you don't have a social security number, a lot of times they have this number. I believe, I'm not 1,000% sure, but I believe the IRS gives it to you. It's called an I-10. And I-10 is pretty much like a social security number. It has the same amount of numbers as a social security number has, but it would allow for you to purchase a home. Now, the thing about I-10 is that because technically the person doesn't have a social security number, it is going to be more the guidelines are going to be a little bit more strict on those loan types. So the down payment, I know they recently went down. The down payment used to be 25, Ivy, and up to 35%, depending on your credit score, depending on what's on your credit profile, depending on if you have 12 months of positive history, then you may qualify for that. But they actually have lowered the down payment option. I've seen it be as low as right now, I have a program or a bank that I work with that does 11%. But then there's credit unions that do I believe it's 3% down. So there's a lot of different options for I-10 borrowers. But yes, this is for people that don't have a social security number. In the guidelines, like I said, it's a little bit more strict because they're going to want to have because you don't have a social security number, they're going to want to make sure that you're legit and you pay your bills on time. So that loan is heavily dependent like on your credit. They look at your credit, they look at your profile. If you are currently renting, they a lot of times are going to want a 12 month history of you paying your rent on time. So there's like a lot of little things you can do where you have to do in order to get that loan option. Then the last one that we're going to be talking about, which this isn't the last loan available. This is the last one we're going to. Well, actually, we will talk about the profit and loss ones as well. But the last loan option that we're going to be talking about is going to be hard money or private money. So this loan option is a loan option that is basically people that have money. So like let's say somebody is a millionaire and they're a private investor. So instead of you going to a bank, you're going to be going to a specific person or specific people that are investors, and they don't go off of guidelines specifically, they go off of their own guidelines. But basically the way that it works is that they will come up with their own guidelines, and they're not unreasonable guidelines, they're very reasonable, but it's going to vary from person to person. So you may be working with person A that has a certain credit requirement, and then you may be working with person B that doesn't have that same credit requirement. But usually they're a little bit more lax as far as documentation. And when I say documentation, I'm referring to tax returns. So they may, a lot of times, if you don't have your tax returns, you may not have filed all of your income on your tax returns, but you have income. There are ways that they are able to determine how much money you make, and they're able to see what you qualify for. This loan option, they have loan options for investors, or if you're going to be buying your primary residence, they have those options. So though the private money loan, they are very because it is a private person that's, making the payments, or not making the payments, because the private person that owns the loan that you're going to be doing, they do have higher interest rates. So I've seen and that it could be a little bit different now because rates have gone up, but the down payment options could be anywhere from 10 point to 11 10% up into 11.75% or even higher, depending on how much of a risk you are as a borrower. So this option mainly is for people that really want to buy property and they may not have all of their ducks in a row or have everything together at that time. you can get a private money loan. This loan option is not a forever loan, so it's kind of like a bridge loan, what we call it. And a bridge loan basically is a loan that you get just to bridge you over until you can get in a different, better loan. So with hard money, a lot of times they have terms where you can't, it's not like a 30-year term. It's like, okay, well, you can have this loan for 2 years, and then after 2 years, you need to refinance back into this private money loan, or you need to refinance into a regular loan, regular FHA conventional loan. So usually when you do this loan, it is not a permanent loan. It's just kind of like a loan you do when you, if you really, really need it. And then when you're able to get out of it, you get out of it. So that's pretty much all I wanted to talk to you guys about in this video about the loans. There is another, or there's a lot more loan options available, but these are like the standard ones you're going to be working with. If you are a business owner, they do, which I didn't mention here, and I'll mention briefly. If you are a business owner, if you are a business owner and you have like for example, me, I'm a loan officer. I get paid 1099 every, or I get a 1099 every year. There's loan options for people that have businesses, that are business owners. So they have 1099 loans, they have profit and loss statements, they have bank statement loans. So those are going to be more into your they're called non-QM loans, which are not non-QM stands for non-qualified loans, and I'll talk about that in a different video. But yeah, so there's a loan option pretty much for everybody. That's one of the things that I realized when I got into this industry, is that there's no, I used to literally think that FHA or first time home buyer is the only loan option out there. But no, there's actually so many different loan options depending on your situation, the borrower's personal situation, what they have going on with their personal life. There are different loan options out there. So, but yeah, I just wanted to share these with you guys. And if you guys have any questions, feel free to reach out to me. If there's any loans that I didn't mention that you want more information on, feel free to reach out to me. Another thing too that I want to throw in here is that I didn't even talk about down payment assistance loans in here, because I'm going to be talking about that in a different video. But yeah, hopefully this was helpful, and I hope you guys have a wonderful day, and thank you for tuning in.